Hello everybody. So today I want to talk about LifeMD and the special situation that really LifeMD is. I titled the video in the thumbnail I wrote, "What if Teladoc and HIMSS had a baby?" You probably would have something that looks like LifeMD, which would be a much smaller player that would have a little bit of both, a little bit of Teladoc and a little bit of HIMSS. And that is LifeMD. What is LifeMD? It's a company that has the mission to empower people to live healthier lives by increasing access to affordable, high-quality virtual and in-home care. Very similar to what both Teladoc and HIMSS do. And if you look at a glance, you can see that they're tiny, $118 million in revenue in 2022, 675,000 consultations, more than 200 treatments, different types of provider. Revenue growth is 28%. I'm not going to read through the whole thing. They have this whole primary care subscription that they're trying to sell, where you can have access on demand to a primary care physician for $15 a month. They have very high gross margins, just like HIMSS and Teladoc, and they also have a virtual primary care right now, which is their fastest growing segment, with 7,000 people paying their $15 a month to have access to this company's service. Just like HIMSS, they have an app which is not confusing, which is very straightforward, very easy, and you get in the app and you get to see a physician, and you can pay for it either with your insurance or you can pay for it out of pocket. And of course, LifeMD connects you to different partners, whether it's lab services, pharmacies, etc. They can connect you to a whole bunch of systems. Again, 675,000 patients so far that have trusted them. They have an all-inclusive app, right? It includes things like virtual consultations, home health tools and wearables, patient education, symptom checkers, supplement and lifestyle routines. They partner with local providers, right? Because it's an app, right? So when you get into that app, you're going to meet with a primary care provider that they're going to partner with, and you're going to get treatment through them. And I think what's interesting to point out is they have a marketing platform. So LifeMD is their main product, right? Which is the family physician. You're going to see a family physician virtually through LifeMD. You can contact them through a LifeMD app. The CEO on the conference call was talking about that right now it's about 50-50. About 50% who come to the app have insurance and 50% who come to the app don't have insurance. And that's their take rate. But the CEO mentioned, for example, for primary care and LifeMD, he said that the biggest hurdle to acquisition is when customers want to use their insurance to pay for LifeMD. That's actually very reassuring, because that means that customers love the platform. They want to use the platform, they want to use the product, but they would rather have the visit with a physician be covered by their insurance. And so one of the things that LifeMD is doing is they're trying to partner as much as possible with a lot of systems, local health systems, to try to get people to be like, hey, yeah, you can use your insurance with us. I remember in another call that I listened to them, they have a lot of patients from other markets, actually, maybe abroad sometimes, who want to see a US trained physician, it's the main business. But like I said, they have a marketing platform. They talk a lot about how good they are at marketing, and they've kind of developed targeted websites for different issues. And this is kind of a HIMSS part, right? The Teladoc part is LifeMD. The HIMSS part is kind of all of these other issues that they look at. So they have a tiny dermatology segment with their own specific website, allergy and asthma segment with their own specific website, REXMD, which is their men's health website, and ShapiroMD, which is hair loss. And so they try to go after these different holistic preventative healthcare through separate brands, and their LifeMD is kind of a Teladoc section. So I think even though they are clearly number 2, number 3, and perhaps even number 5 in all of these categories, they're kind of this diversified mini provider of services. Hence the title of the video. What if HIMSS and Teladoc had a baby? It probably would be LifeMD, because LifeMD is tiny, is small, it's growing fast, and it does a little bit of both what HIMSS and Teladoc do. But let me talk about the growth now, and you're going to see that this company, even though it's very small, it's a micro cap, right? 50 million market cap is very tiny. They're growing so fast. So of course, from 2020 to 2021, they grew at a 149% rate. But before that, right, from 2019 to 2020, 200% growth. That was insane. And then, of course, like all traditional healthcare, like all healthcare that has to do with family physicians, and that's something that we've noticed for Teladoc. They've seen a drop in their growth, only growing 28% between 2021 and 2022. It is noteworthy to think that they may have been saved by a lot of their preventative services like dermatology or men's health, and it's also noteworthy that they may have been saved by another business that they have that I talk about, which is WorkSimpli. They actually own another small business, which makes this story so interesting in my view. But moving forward to the guidance, so we know that right now people are still going back to the doctor in person. That's still a kind of a knee-jerk reflex against what happened in 2021, where everybody had to go online, right? And so people, but that doesn't change the megatrend. Like, I believe that megatrend is intact. I believe that over time the share of remote doctor appointments can only grow. That's my view over time. And actually their guidance kind of agrees with me. When you look at their guidance, they are guiding between 18 and 26% superior growth, right? Extra growth, sales growth in 2023, which is significant, right? It's not quite like HIMSS. It's not as much as HIMSS, but it is much better than Teladoc and much more than Teladoc. So kind of reassuring here. Gross margin, they're expecting it to trend in the right direction at 87%, and they're expecting positive adjusted EBITDA between 12 and 18 million. And I think in this case, in the case of LifeMD, EBITDA is a good proxy for cash flow in their case. And by the way, they are projected to reach cash flow by mid-2023. This is their representation of their EBITDA right here. You can see that they've just reached it in the last quarter, and they're gonna reach it on a full year basis in mid-2023. Gross margin trending up, and their marketing costs are actually in general trending down relative to how many sales they have, right? You want to see this trend down as a percentage of sales. So this shows that their marketing is getting better and better over the years. But let me talk to you about that bonus, right? That bonus that they have. So like I said, so this company is going to grow, but when they noted in the growth, so they said here 28% growth, right? Not here, sorry, right here, up to 26% growth next year over the next 12 months. And when you listen to the call, the CEO talks about this, and the CEO noted that they expect that in 2023, about $100 million of revenue will be from all of the healthcare-related activities. And so you may ask, where does the rest of the money come from? Very good question. The rest would come from their business, a business that they actually invested in very early on, back in the 2017, 2018, and they own a majority share in a tiny SaaS company called WorkSimpli. Now, the CEO on the call clearly doesn't talk about WorkSimpli much. They are an healthcare company. That's what their business is. That's their expertise. But they've nonetheless been very, very lucky or very savvy to invest in a company like WorkSimpli. WorkSimpli contributed 36 million of revenue in 2022, and that was up 47% from the year prior. And they're expecting this revenue to keep going at WorkSimpli. So they're getting these dividend checks from this subsidiary that has nothing to do with remote healthcare. And the SaaS business, the little SaaS business that I have, is profitable and has 20% EBITDA margin and is accretive to the business. And actually, when I look at private valuation or reasonable valuations of what a business like WorkSimpli is worth, I would argue WorkSimpli is likely worth between 50 and 75% of the market cap of this company, of its current market cap, because it's a business that's earning 36 million of revenue in 2022, right? And it's probably going to be up again. And this is mostly recurring revenue. And WorkSimpli, by the way, if you're curious what that is a workplace simplification SaaS company. It's essentially a cloud platform where you can sign PDFs and annotate PDFs and documents. Anyways, that's a very, very very minor company, but it still creates tremendous revenue for LifeMDs. This company, I could argue, could be public on its own, and so that provides a big margin of safety for this stock. Okay, let me recap the stats for LifeMD. So I'm going to recap the stats now. 119 million revenue trailing 12 months. The guide, I'm going to give them the benefit of a doubt and assume that they're going to reach the higher end of the guidance, given that everybody's sandbagging in 2023. 150 million guided for 2023. Their gross margin guided 87%. They're going to be cash flow positive. The enterprise value currently is 50 million. The market cap is 46 million. So when I go through my usual metrics of how I value companies as a hyper-growth investor, right? I don't value them as a value investor, but as a hyper-growth investor, I care about how much am I paying for that growth, right? So when I look at enterprise value, and by the way, feel free to replace it with sales if you're more comfortable with sales, because it's about the same number. Enterprise value is just a tad higher because they have a teeny tiny bit of debt, but it's not really meaningful for this. So enterprise value over revenue, right, is a 0.42. Enterprise value over forward revenue is a 0.33. Enterprise value over trailing 12-month gross profit is a 0.5. Enterprise value over forward gross profit is a 0.38. And enterprise value over gross profit over revenue growth, that is answering the question, how much am I paying for each percentage point of expected revenue growth? How much am I paying? Am I paying up for that growth? What's the cost of that growth? And they're coming up as a this is not a typo, at a 0.014, which is, eight times cheaper than HIMSS, and, let's call it 25 times cheaper than Teladoc on a enterprise value over gross profit over revenue growth. This is an anomaly as big as I've ever seen it. This stock market has entirely forgotten this stock, probably because it's a micro cap and nobody wants to own a micro cap. It probably has a lot to do with that because a lot of brokers don't even accept micro caps. But an anomaly like this, I have never ever seen. This is a company that clearly has no support whatsoever from the market. Clearly, this is a company. That is just so cheap, just too cheap. And when I look at, for example, how poorly they did, right? This is a company that was actually close to $30 a share, trading at about $30 a share. And if you look at what happened to the stock, it's down 95%. So the stock has been cut by 20. This is a stock that has been cut by 20 since February of 2021. Yet, look at the anomaly in this market. The sales are way up. The cash flow way up. So everything's trending up in the right direction when it comes to the business. But the stock price, this is an example of the stock price, in my view, not reflecting at all the fundamentals of the business. Yes, they are number 2 or number 3. Yes, they are not as good as HIMSS. They are not as good as Teladoc. Yes, they have plenty of competition. But they're also in a huge market. And they're also growing despite all of that competition. And they are not at risk of bankruptcy. And so when you look at their numbers, you see their product is still getting adopted along with other products. And the stock has been cut by 20, probably because it's a micro cap. It's in no ETF. There's no backstop at all for this stock. So that's why it dropped almost to $1 prior to earnings. But by the way, after earnings, it popped almost 50%, like almost 50% in 2 days. Very volatile stocks. So what is my plan, you may ask? Well, let me just say that this stock is too micro for me to include in my regular portfolio. It's too thinly traded. I believe this is part of a big risk of owning this stock. It's too thinly traded. It's too tiny. And like I said, it went up 50% in 2 days after earnings. You saw when there was a banking crisis, it dropped by a full dollar, and it was totally unrelated to them. So this is a stock that's crazy volatile. And if there is a risk in volatility to this stock, and if this stock is not going to be rewarded for being what I believe looks more or less like a sound stock, if it's not going to be rewarded by the market's going to bounce it around regardless. My view is, why don't I just embrace the volatility and just get a leap on the stock? And I've done this a few times. I don't do this very often, but I've done it a few times, and I'm considering doing this for LifeMD. Actually, much more than HIMS. I think this is a better stock to do this on than HIMS even. So for example, when I look at the LEAPS, they're long-term call options, right? That's what I'm looking at. If I look at the long-term call option and call option that expires in January 2019 of 2024. So that's still quite a ways out, right? Almost a year out, not quite, but almost. The strike price is $250. The strike price is $250. And so, of course, you buy 100 of those. The price for each contract is 0.32. For each right, it's 0.32. So you buy the contract, is 100 price 0.32. That would be $32. It would be $32. And of course, you can lose your $32. You can lose, if you just want to buy one contract, you can lose your $32. But I think for a company that is so volatile, this is kind of the magic of this, because so assuming that this stock doesn't go back to what it was trading at 2 years ago, right? Traded at $30 2 years ago. Assuming it doesn't go back to that, but assuming it goes back to like $15, which is kind of a max that I've put in this table. And by the way, in this type of setup, you would start breaking even very, very early on. Like as long as the stock gets past 250, you start breaking even, right? You can see it in my table here. So like if the stock in January of 2024 was in the 5-ish or 4-ish range, you're already winning quite a bit, right? You're already at like 200% gain, etc. So you're getting outstanding returns. But let's imagine this. So. And this is risky. This is play. This is playing, in my view. This is not investing. This is playing. But like I put here at the end is don't underestimate my ability to obtain entertainment out of spending $32, or $64, or buy I don't know 300 contracts or something, not contracts, but free contracts for 100 stocks. Don't underestimate my ability to have fun with this, right? This is exciting to me. This is a type of exciting risk asymmetry. Typically, options I find pretty exciting, but let's imagine this. So if it were to go back to $15 by January of 2024. That would be 15 times 100, right? Where you have 100 stocks in each contract, so that's $1,500 is what the stock would be worth. You could buy those $1,500 worth of stock for $250 because you've locked in the strike price of $2.50. That means that your proceeds would be $1,250. The cost of the option is $32. You do 32 compared to $1,250. Of course, $1,250 is 39 times higher than 32. So that's so much leverage, right? That is a lot of leverage if you're making that bet. You're amplifying your leverage, and I believe, like in my view, That's kind of the way, because I don't feel comfortable making this a serious position for me. I would consider it for fun, and so for fun, it doesn't bother me to, drop $100 on free contracts, and kind of make a bet, because when you think about risk asymmetry, this is an example of a stock to me that has clear risk asymmetry. I mean, if this stock were to trade just in line with a stock like HIMS, you'd be closer to $10 in the stock price, and HIMS is dirt cheap. HIMS is extremely cheap. So this is a company that's still growing. This is a company that's going to be cash flow positive by mid 2023. This is a company that's going to have a lot of catalysts. And so to me, that's fun. Obviously not advice whatsoever. This is no advice. This is just entertainment, literally entertainment, not advice. I appreciate your likes and subscribes, and have a wonderful day. Thanks for watching.